Hey traders, it's Matt Stevenson with Paragon Funded Trader. How are you? So let's talk about, I'm sure you see this is a common title, I'm sure, and I'm sure we will be repeating some things you've probably heard. But I want to talk about them because they're so important, and I want to talk about them in a perhaps different way than they've been talked about before. Because getting funded is difficult. We all know this. The pass rates tell us that. But keeping a funded account is where most traders just fall apart. Because once you're funded, the game changes. You're no longer focused only on passing an evaluation or hitting a target. Now you're trying to protect capital. You're trying to stay consistent and continue receiving payouts over time. In this video, I'm going to walk through 5 rules that consistently funded traders follow. Rules that most people hear, ignore, and then wonder why they keep blowing up accounts and starting over. By the end of this video, you'll understand exactly what separates traders who keep getting paid from traders who stay trapped in the cycle of excuse me, passing, failing, and restarting, and resetting, and all of that ecosystem. And if you appreciate this type of content, go ahead and gently tap that like or subscribe button. But for now, let's get to work. So a lot of traders assume success comes from finding some secret strategy or magical indicator. But if you spend enough time around consistently profitable traders, you notice something interesting. Most of them don't operate very differently from each other. If I had to describe these types of traders, the profitable, consistent traders, in one word, I'd say calm. They remain calm or disciplined or steady. They're very steady. And that comes with experience, and it comes with time, and it comes with mastering your emotions. They are steady. They know what they're going to do all the time. Because at any point in any market, they are able to say to themselves, this is not my first rodeo. I've seen this before. I'm not going to take the bait this time. So the more steady we can be and the more we can stick to our plan, the better. The difference usually isn't the setup, it's the behavior, like I said, the habits, the rules, the things these traders refuse to violate, regardless of how they feel in the moment. That in the moment gut feel, these traders don't do that. But let's start with the first rule. Never exceed your daily loss limit. No, not even by $1. And when I say that, it strikes a nerve because I remember early on, I blew probably 2 or 3 accounts by exceeding the daily loss limit, and literally it was like less than $2. I mean, that is painful. And it's painfully obvious, but this is exactly where a lot of funded traders destroy themselves. Because nobody wakes up and says, today I'm going to violate the account rules, right? Who says that? Instead, it usually happens gradually. You're down for the day, you feel frustrated, you're getting tired and emotionally drained. You tell yourself, one more trade. I just need one more setup, one more good setup, and I can get back to break even. And that's where things start to come off the wheels. Because that trade usually isn't being taken because your system told you to take it. It's being taken because your emotions told you to take it. Professional traders understand something important. You can recover from a losing day, but you can't recover from a terminated account. Okay? Set alerts before danger shows up. If your limit is approaching, stop trading and protect the account. Protect the account. Tomorrow always exists. Rule number 2, size every trade the same. Okay? No matter what. This comes from evolving your trading plan into a work of art that is uniquely tailored for you. You will learn as you journal all your practice trades what that size needs to be. So, size every trade the same way. We're not going to size based on confidence. We're not going to size based on excitement at the time. We're not going to size based on how perfect the setup looks. Because confidence and probability are not the same thing. Some of the trades you'll feel incredible about will end up failing immediately. And some trades you'll barely notice end up becoming your biggest winners. Professional traders understand that they don't know which individual trade will work. Think about that. Steady, right? They don't actually know which one's going to be the home run. They just keep doing the same things that their trading plan dictates. And where did that come from? Their practice. Their practice, their education, their training, their mentorship, whatever. It got them to that point, so they trust in it. They only know what their system tends to do over a large sample size. Trust in the system, trust in the trading plan, and the numbers will work themselves out. It's simple statistics. It's the law of math. It has to, right? Unless the markets are completely changed in how they operate, which they don't. Consistency in position size keeps emotions out of the process and allows the probabilities to actually play out. Let me just quickly pause here. If there's a funded trading habit or rule you'd like me to go deeper into, drop it down in the comments because I'll go ahead and do that for you. Rule number 3, avoid trading around high impact news events. Even if your prop firm doesn't explicitly restrict it, a lot of traders think news creates opportunity because they see large candles and rapid movement and oh my gosh, I could have made so much money. What they don't see is what's happening underneath. During those events, spreads widen massively. Liquidity disappears. That's why you see so many massive fair value gaps. Slippage increases. Orders get filled at unexpected prices. You think you got it at one point, but you forgot to set the limit on that order. So it's just a stop buy. And suddenly you bought it at a way higher price than you thought you would. And suddenly you can be stopped out at on a trade that actually moved in your direction, and where you had your lines it would have been great, but reality what didn't happen that way. You can be completely right about a trade and still lose money because of execution conditions, and news events are times like that. Professional traders understand that sometimes the best trade is no trade. I've said this for decades. Sometimes the best trade is cash. Stay in cash. That's also a trade because you're choosing not to trade cash for something that's probably not going to work. So just keep cash. If you don't see a trade, don't force it. Block major, have the economic events on your calendar so you know they're coming. And, you probably want to sit it out, wait for, the dust to settle or hedge your position. But don't base your trading plan around news event trading because prop firms, they all have news event trading rules. And let me just pose a scenario. So Paragon Funded Trader, our firm, has a news event trading rule. You cannot trade before and after 3 minutes. So we have to have a rule, right? But I can already envision ways in which that can trip someone up. Because how many times over the last year has a news event been precisely disseminated at 8 o'clock on the dot? No. And let me describe another scenario. One of the major news events is the Fed chairman speaks. How do we know when that started and when that ended? We don't. So, let's we're not gonna use vague language, and seek out opportunities to those gotcha opportunities. Oh, we can fail them now. We can breach their account now because they broke that rule. We don't seek those opportunities out, but we know a lot of firms that do, and news event trading can get you in trouble with prop firms that are looking for reasons to eject you. Okay? Plus, all the things I just mentioned. I mean, it's just not a very favorable time to be getting involved. You can be whipsawed. One time, I was a new trader. I got excited about news events because I saw those massive candles. Everything I just said, I put a bracket trade on, stop losses. I thought I was protected, because of my stop losses. No, I got triggered in going both ways because it whipsawed in a matter of minutes. And so I got triggered on the buy, stopped out, triggered on the sell, and stopped out. Good times. Rule number 4, journal every trade. Not because it feels productive, not because everyone says you're supposed to. Do it because data removes guesswork. Honestly, people, and no one gets this more than me. I hated journaling when I first started trading. I hated it. To me, it didn't feel like a value add activity. And if anybody knows me, they know efficiency is one of my main goals in life. I try to cut out anything that isn't value add in my life. And journaling just seemed like it was busy work, and I don't like busy work. But I'm telling you, my journal became more valuable than gold. So do it because of that. Because after enough trades, maybe 50, maybe 100, maybe several hundred, patterns begin to show up. You start noticing things like which sessions produce your best results, which setups consistently work for you, which setups quietly destroy your performance. Maybe you realize you're profitable during certain sessions, but struggle during others. Maybe you realize you lose money every time you trade breakouts. Maybe revenge trading keeps showing up after losses. Without a journal, a detailed journal, you're relying on memory, and memory is never going to cover all that. Memory is terrible at recognizing patterns, but data doesn't lie. I'm telling you, when I went back after hundreds of trades, I always thought I was really good at a certain strategy. But then I went back and looked at my journal, and turns out that was my worst performing strategy. I thought I was great at it, so I did it a lot, and I lost a lot. So thank goodness I had my journal, and it was detailed and it was accurate. So, and the more you put in it, the more you're going to get out of it. So, even emotions, enter emotions in your journal, what you were feeling at the time. You know, were you feeling a little on on edge or full tilt or with revenge trading? I mean, put that in there if you can actually think of it when you're doing it. And like I said, the more you put into it, the more you'll get out. Rule number 5, when you hit your monthly target, reduce size or stop trading. Guys, I have done this. I hit the profit target well before I was trading with a prop firm many years ago that said it was 30 days long. You had to be trading for 30 days. Or you didn't have to trade every day, but it was going to be 30 days, whether you hit the profit target in the first 3 days or not. So, what should I have done after 3 days? Just stopped. Well, I kept trading and I blew the account. I mean, is I can't think of a more idiotic time in my life. Anyway, there's absolutely no reason or excuse for that. But when you hit your monthly target, reduce size or stop trading. This one surprises people because most traders think, I'm winning, I should press harder. Why? Do they give you, you know, chocolate chocolates and candies and bonuses if you go far past the target? No, all you have to do is hit the target. So you're not getting any any extra perks for going above and beyond. But experienced funded traders often do the opposite. Why? Because once the money's already there, protecting it becomes more important than trying to squeeze more and more gain out. A lot of accounts get blown after targets are already hit, like I mentioned. The target gets, the trader gets overconfident. Trust me, you get this, um, there's a bias where you're having a great winning streak and you think that you're suddenly you're King Midas and every trade you touch is going to be gold. That is a dangerous spot. So the trader gets overconfident, starts trading larger, starts trading more often, starts forcing setups because he thinks he can't lose. He's in the zone, right? Then suddenly the gains begin disappearing. Professional traders understand protecting money is part of making money. It's one of the most important parts of making money. And if you want to know how to build these habits during the evaluation phase before you're even funded, we have a video that explains that as well. Now, I know these rules sound simple. I've tried to explain how they're not. So hopefully I did an okay job at that. But that's the funny part. Most traders have already heard every one of these rules before. But hearing a rule and following it, two very different things. As we all know, those of us that have prop traded for long enough, we know that these things are not easily done all the time. But we need to keep striving. And one thing I was going to say about consistently funded traders is one word that describes them is steady. They remain calm. They follow their plan no matter what's happening. No matter if they're in a slump or they're in the longest winning streak of their life, they're not changing their plan based on that. They remain steady. It's vital. Funded traders who last aren't necessarily smarter. They've simply built routines and systems that keep them from making avoidable mistakes. Like I said, over time that consistency compounds. Hopefully this gave you a clearer picture of what consistently funded traders actually do differently, because long-term success isn't built on one amazing trade, it's built on small decisions, repeated over and over again. If you found value in this video, make sure to like, subscribe, and let me know what topic you'd like covered next in the comments, and I'll see you on the next one.